First of all, pleasure to be part of this summit. So, I'll just give a quick snippet about what we have been doing in this space. So, at IFL AMC, we have pioneered this concept of late stage tech investing with the thesis that several of these new age companies will eventually, with sustainable business models, will have a great outcome in terms of a good listing. And over the last 6 months, the thesis has played out very well. And we have seen several tech IPOs getting listing. Some of them have been very well received. Some of them haven't fared well. So today, I just wanted to spend some time talk about our approach to late stage tech investing at IFL AMC, and how do we identify winners, especially companies which will be seeing sustainable business models from an IPO perspective. So this is largely a approach to late stage tech investing, what we have done at IFL AMC. There could be multiple approaches to late stage tech investing. And some of the illustrations which I talk about are part of our portfolio companies at IFL AMC. But having said that, a caveat, there are several other companies which are not part of a portfolio, which are again great business models. But I'm just talking about companies where we've already spent time and we understand the assets well, more from an illustration point of view, since we know them very well. But there could be many more illustrations as well. So broadly, there are three pillars to our entire late stage tech investing. One is that in terms of themes, we have clearly identified three themes. These are basically large platform opportunities where the underlying modes are very well defined. So we like three themes. We like winner takes it all model within the entire tech space. We like market leaders within vertical e-commerce and also the vertical enterprise play. And third, we like some of these very unique, differentiated tech offerings. So some of these business models where the entire space can only be enabled via tech, and that offers you a very large white label. I'll talk about this in the next slide about these themes. And apart from that, very clear focus in terms of criterias. We have built a very strong framework around this. Again, this criteria is such that these are hyper growth companies, but have very strong sustainable business models. And idea is to go and pick some of these assets which will not just rely on multiple rounds of financing, or they'll not rely on largely long-term burn, but eventually they'll have a part to sustainability. So for that, we again have three criterias. We look at some of these multi-decadal growth stories, some of those opportunities where the underlying TAM is very large. They are largely structural beneficiaries of the entire internet adoption. Second, we look at businesses where the overall unit economics are already established or are on track to turn positive. And there's very strong focus on businesses where they have a clear path to profitability. And third, we look at businesses where the overall competitive intensity is low. Our thesis on tech is that typically tech should enable to create you a lot of network effect, and it should able to create you a lot of market dominance. And we typically like to be in those spaces, those categories within tech where the underlying competitive intensity remains low. I'll talk about this criteria and more nuances about how do we look at some of these criteria and what are those approach to it. And apart from this, the third pillar to tech investing is that we invest across the entire late stage spectrum. So when I say late stage, this could be anywhere from a late stage to a mature late stage to pre-IPO. So this is not a pre-IPO fund. Typically, we come in these companies much earlier. Anywhere companies which could have an IPO in, let's say, 3 to 5 years is where the sweet spot for us is there in terms of coming in some of this opportunities, some of this portfolio companies. And the thesis is that the underlying economics, underlying business model, underlying modes are such that eventually these companies will have a great outcome when they get listed. So coming back to, I'll just double click on some of these themes and criteria and give you a better perspective on that. So this is a snapshot of some of our portfolio companies. This is part of the portfolio. We have built almost 20 tech company investments where most of them have done very well. Almost 18 companies have already seen significant up rounds. So broadly, there are three themes. One is that winner takes it all models. So by nature, the industry dynamics are such that the segment tends to be either a monopoly or a duopoly kind of play. If you look at food delivery, you had 6 players at one point of time. You had a bunch of companies, but today you've seen fair bit of consolidation and winners have emerged there. Again, something like Policy Bazaar in the entire insurtech space almost has 90% market share of the entire insurance aggregation space. And again, within online insurance, it has almost 50% market share. So this some of these categories, they tend to become winner takes it all model. It needs a lot of funding upfront when you're creating the entire network effect for the business model. But once you have done that, you tend to see a lot of organic visits coming to your platform. The overall CAC keeps coming down, and the network effects are so strong that in some of those business models, they're very symbiotic. Like for example, in food delivery, the entire proposition is such that it's actually benefiting the restaurants to have a much higher throughput. At the same time, by able to bring in food delivery partners, you're able to service the customers. So we also look for some of those nuances about some of those business models where the overall quality of relationship between some of the stakeholders present there. That also is where we typically like to pick some of the winner takes all model. Second theme was market leaders in vertical place. Again, based on our work across the spectrum, we have picked several assets in these verticals across these categories. And our thesis here is clear that horizontals are great. Flipkart and Amazon, they do fantastic thing. But some of those categories are actually meant for verticals to emerge because they need a lot of customization, they need a lot of specialization. So anything like Licious, which we need a lot of specialization and tweaking of the supply chain to offer meat offerings. Or for example, Nika, you need to create a different approach to building out the entire personal care segment. Bunch of edtech companies which are backed in this space. And for example, something beyond this, some companies like Lenskart, where you're trying to solve for a very typical supply chain for the entire eyewear segment. So the thesis here is that dominant players are going to emerge across verticals, especially if the supply chains are very complex. The approach to engaging with customers are very differentiated. And within that segment, you will eventually see winners emerging. And that's how we have tapped into the second theme. And third theme, this is a very interesting theme. And we have had several multi-baggers coming out of this third theme in our portfolio. So this is a theme where we're backing some of those very differentiated tech business models. So some of these companies are so unique that only via tech you can create an offering in that segment. So entire white label of that entire space is actually getting opened up by the tech offering. For example, like Zetwork, if you look at entire tech-enabled contract manufacturing, this was something this word even was not there a decade back, right? And Zetwork has been able to create something in this space in a span of 3 to 4 years, by enabling the entire contract manufacturing by its tech platform. And it's such a large opportunity. The entire industrial manufacturing space itself is such a large opportunity. That's the reason some of these companies are seeing the kind of hyper growth. What do we see in this kind of assets? And we like this third thing because this is where we feel some of those business models eventually, when they get listed, will be highly appreciated by the markets. Similarly, like Pine Labs, it's a market leader in this entire enterprise POS terminals because of their inherent strength in terms of the connect via POS. They're able to get into a lot of adjacencies. They're able to open up BNPL. They're able to open up gift cards. So the networks eventually lead to a lot of value creation in adjacencies which are not even present today. So these are the three themes where we are really focused on, and that's how we go about getting our investments done. And on the criteria which I had mentioned, probably I'll just give some nuances to explain it better in terms of when we say multi-decade growth opportunities, when we say large TAM, what exactly are we looking for? So there are four subparts to this criteria. So when we say large TAM, we like to look at the quality of the TAM as well. Like we prefer businesses which are industry structures which are fragmented, which are unorganized. So this is where typically you start seeing where tech typically ends up disrupting this entire space. So again, like if you look at meat as a segment, it's massive TAM opportunity of $44 billion. And within that, almost 93% is unorganized. So it's a clear segment where tech is really going to disrupt. Can you create a platform which is a direct to customer platform, and you're able to take care of all the requirements and create a brand out of it? And that's the thesis behind investing in Licious. Second example would be Homelane. So if Licious is more of an unorganized play, Homelane is more of a fragmented play. So if you look at the entire home interiors, again, a very large opportunity of $18 billion, but the segment is very highly fragmented. And that's the reason if you're able to create a strong brand with very focus on execution and great customer service, you're able to create a really great opportunity. So that is the first part. The second part, we look at companies, we like to invest in companies which are full stack play. And we have a preference, we prefer full stack as an opportunity play. Because what you're seeing is that when the company is full stack, when it owns the entire supply chain, it owns the entire distribution to the customer, it's able to give a very enhanced customer experience. And in that process, the customers are also okay to give you a slight premium. At the same time, with this full stack play, companies are also able to drive away a lot of inefficiencies. For example, we are invested in Country Delight. It's a fantastic play in this entire direct to consumer branded play in food essentials. They are a mass premium brand with where they own the entire brand and the product, and also they own the channel to the customer. And since this is only one company where its own branded play, and you're reaching out to the customer doorsteps on a daily basis, and that is where it creates that kind of stickiness with the customer, and hence you can actually create a lot of other adjacencies beyond what you're doing. Again, like Exotel, we had backed this company when they were largely a customer cloud telephony company, and as we speak, this company has expanded into a larger customer engagement platform. And over this journey, we have seen significant value addition creation, and that's where actually we're seeing significant re-rating also in terms of the company, and the company has been doing really well, scaling up at a very rapid pace. The third part of this criteria is we like companies where we're trying to solve for some structural problems, and the structural problems can be only leveraged by technology, and you're in a way trying to disrupt the entire value chain. So I gave the example of Zetwork. This entire value chain is so massive, but the structural, there are a lot of challenges. Large manufacturers are not comfortable dealing with multiple vendors. But if you provide a tech-enabled platform, the universe really opens up for large manufacturers. At the same time, for small SMEs who are at a very suboptimal capacity, they're able to enhance their capacity utilization. So we like some of these plays where the underlying structural dynamics are such that you can actually create a very disrupting business model. Again, this DealShare is a fantastic company. We came at a very attractive valuation there. It's a company into this entire social commerce group buying space, and this is a company where you're able to disrupt the entire buying behavior of customers in tier 2, tier 3, tier 4 geographies. And that's the reason, if you look at all Zetwork, DealShare, they're actually scaling up at almost 300, 400% kind of CAGR on a yearly basis. And the fourth theme, fourth subpart of this entire TAM opportunity is that we like businesses where the network effects are so strong that eventually you'll be able to get into adjacencies, and that adjacency itself will be a large revenue opportunity, and to also enhance the overall margin pools. So for example, when we came in Daily Hunt, we liked the entire short video aggregation platform of Daily Hunt, but they didn't have Josh at that point of time. But given the platform what they had, we believe that there will be huge optionality they can create by creating Josh in the short video space. And today, Josh is the leading player in this entire short video platform with almost closer to 180 million MAUs. And that's where massive value creation has happened in Daily Hunt. And that's where you're seeing multi-bagger kind of returns. At the same time, companies like Swiggy, which were largely food delivery, but with a larger ambition of being a hyper-local on-demand play, have been able to segue from food delivery to Instamart and to several other propositions. And that eventually creates a very large opportunity in terms of adjacencies and in terms of optionalities. And we like this as well when you look for opportunities and the underlying platform, and can they identify some adjacencies which might eventually work out in the future, which has a higher probability of success. The second criteria which we look at is, this is a very important one, especially for investors who are coming in the listed space, where the focus is a lot on the business sustainability. We definitely like the hyper growth pattern of some of these companies, but at the same time, we are very sacrosanct about how the unit economics of some of these assets are and how the path to profitability is going to be. If we don't see that, and if you only see a growth in terms of user base or broad revenues, we typically tend to stay away from those kind of assets, because eventually markets tend to, at least in the listed space, I don't think so the markets will have that kind of patience to back a company for 5 to 6 years with the hope that someday the profitability will come back, right? And they're going to really punish some of these business models where they might be creating great value in the entire ecosystem, but if it's not resulting in great economics, markets are really going to punish, especially more on the listed side. In the unlisted side, still there will be fraud in some of these companies. But broadly, there are again three parts to this. We like businesses which are capital efficient. We like businesses which are having low EBITDA burns, having high asset turnover, having negative working capital. So, for example, Nykaa is a great example of an asset where it was built on high capital efficiency. They had just raised about $70 million to build, in terms of the primary capital, to build what they did. Again, like Homelane, if you look at in this entire home interior space, it's the only player which is really focused on the entire focus in terms of path to profitability. It has very strong financial discipline. At the same time, they really focus on customers, have a very strong focused approach to the customers, and they're actually offering you the kind of NPS what Homelane has is the best in the space. That's an indication about the sustainability of this business models. And second part to this theme is we like businesses where underlying operating leverage is fairly high. And for example, if you look at Policy Bazaar or some of those edtech companies like Upgrad and Byju's and all, the underlying gross margins are very high. And in case of Policy Bazaar, the overall contributions are almost 40%. So the core business is actually in a position when the scale comes in, it'll be in a position to generate very high operating leverage and high profitability. And again, third part to this theme is we like businesses where we focus a lot on non-traditional approaches to investing, and given the kind of valuations we have to where tech companies trade, we actually focus a lot more on the quality of revenues, quality of customer engagement, and that's a key area of focus for us. So we focus a lot on the kind of cohorts, what are the cohorts indicating, and we like businesses typically where the businesses tend to have very high LTV to CAC. LTV to CAC is the lifetime value of customers are fairly high, and on the denominator you have CAC, which is the customer acquisition cost. So this is an indication of businesses, even though CAC might be higher, but if the lifetime value of the customers are going to be phenomenal, it's an indication, it's a lag indicator of, it's actually a lead indicator of how eventually the business is going to really scale up. For example, in our portfolio, Country Delight has M12 customer retention of 61%. This is an unparalleled number. There is no other business model which has this kind of customer retention. At the same time, something like Licious, typically on a customers who have spent 12 months on the platform, they end up spending more than 20,000 rupees on the platform on a yearly basis. So that talks about the quality of revenues, the quality of retention, the kind of repeats what you could see going forward, how the revenues would actually scale up going forward, and we gather a lot of comfort from that. And third, coming back to the third part of this criteria to investing in tech companies in the late stage space, we again have four different pillars here, subparts to this. One I've already spoken about. We like monopolistic, duopolistic business models. They typically this space might still see high burn, the way we are saying in Swiggy, Zomato, with there are equal market share duopoly. The underlying unit economics are positive, and these segments are going to have good operating leverage. So if the underlying dynamics are in favor of some of those, the entire space, we actually like to back some of these companies. And again, like Policy Bazaar is almost has a 50% market share in the entire online insurance space. Second, we like some of the business. Yeah.
Yeah, we really out of time. I mean, in fact, 10 minutes over. So I mean, just take a few minutes if you can quickly.
Sure, I think so. I should be able to wrap in next 2 to 3 minutes.
Yeah.
So second part is we like some of this business where the entry barriers are rising from scale. A company called Leap, which is into asset pooling. The inherent initially you need to invest a lot of capital in terms of building the entire networks, and eventually when the network pans out, you're able to get a lot of good dividends out of it. Again, it's a dominant player in a duopolistic asset pooling segment. And third part, I guess I already touched about how do we look for companies where there's market leadership. Companies like Pine Labs or Nykaa. Pine Labs has 65% market share in the entire enterprise POS. Nykaa has almost 25% market share in the online BPC segment. And fourth is largely segments where there's a large white space which is being enabled via tech. For example, Daily Hunt was the only player which was doing large-scale news aggregation focused on the middle India. And this is the last slide. So basically, this is how the landscape, how do we look at the entire landscape in the entire internet category, internet economy, and we invest across the entire ecosystem. So the blue grid is where typically is again proprietary research at IFL AMC. What we have done, the tech team has actually focused. The blue grid is what is the one where we really focus on, and this is an indication of companies where the overall uh, path to profitability is great. So the inherent gross margins, the contribution margins, the LTV to CAC ratios, and on the y-axis you have this competitive intensity where typically we like to focus more on low to moderate intensity. And there are segments like payments or other segments which we have stayed away because we have not got a comfort about how the path to profitability is going to be for this kind of company. And consciously we have stayed away from that. And clearly, what we like is edtech, we like food delivery, we like enterprise tech, we like gaming, we like B2B commerce, we like vertical commerce, we like insure tech. And selectively within content also we like some opportunities, but not all content plays. But broadly, these are the companies, these are the categories where typically some of the underlying themes and framework which I mentioned, they actually converge pretty well. And the idea is to go deep dive into these companies and try to find the right assets. So I hope I'll pause here in the given the paucity of time, and I hope this was useful for all of you to get a perspective about how we're approaching to tech investing at IFL AMC.